Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing dollar cost average in dividend growth companies with positive cash flow, more than enough to cover their dividend in growing companies and with the high return on their invested capital. I utilize a dollar cost average approach, consistently investing into the portfolio on a weekly basis. But I also do large purchases if I have extra funds like a bonus or do a side job. I cover all my investments into the portfolio on this channel. There's nothing to pay for. I don't have a paid Patreon account or some paywall or some other site that I send you to see what I'm doing. It's free to see what I'm doing. This is going to be a portfolio update. I cover these every Sunday. We did add $1,763 into the portfolio, and again, it's free to see what I'm doing. So we're going to cover everything that happened in the portfolio. I do some options, so we'll cover the options if we did any. We'll cover any dividends received, and we'll cover the purchases. But before we get into the video, if you would like to help me out, go ahead and hit that thumbs up button down below. If you are a dividend growth investor yourself, make sure you have subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Hit the notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you are buying right now. Again, it is free to see what I'm doing every week. Every Sunday morning we do this portfolio update, but doing all that really does help out a small YouTube channel like mine. So really do appreciate all of the subscribers out there. The channel continues to grow because of people like you. And let's jump in to the options. So we did have an options play hit. We actually threw out a couple more than just this one, but this is the only one that hit. So we did one contract, right? So sold to open a covered call. That's what the -1 means, one contract. A $95 strike price. It ended on May 24th. We opened it on the 20th. So Friday it ended. It did not jump up to $95 was the strike price. It did not hit that. So we received $36.45, $37 minus the fees here, right? But $36.45 is what we put in our pocket. So that goes into the options. And then you can see here it expired. Didn't hit 95. I think it was actually back down into the low 80s. So I could have gone a little bit lower here. 92 or $90 per share would have given me more options premium. But that is the nature of the options I am running right now. I'm being pretty conservative. I don't want these positions to necessarily be called away. I just want to collect the options premium off them. Now I am going out far enough where I'm comfortable if the company did get called away, like BABA. I am comfortable right now. I was buying this in the low and mid 70s. So my cost basis is around $70 per share. If it was to hit 95 and this was get called away, I'd be happy with that gain plus the premium, the options premium I've been receiving on it over the last several weeks. So I am being conservative. That's why it's not much of an options premium, and I am trying to keep these. Now, if this was a position that I was wanting to get rid of out of my portfolio, I might take a little bit more options premium with less of a strike price, like I said, maybe down into the $88, $90 range, and get more options premium, but then the likelihood of the position being called away would be greater. So $36.45 in options premium. No dividends received, and you will notice whenever we cover the total passive income added for the week, the last several weeks we've been right around, if not over $100 per week, but we've also gotten a lot of dividends, and you'll see how the dividends impact that weekly cash flow here at the end, because it's going to be significantly lower than what it's been last several weeks, and the only difference, we didn't receive any dividends. So no dividends this week in the portfolio. Now we're to the first buy here. We did add $1,410.50 on May 20th. With those funds, we picked up 6 more shares of Comcast Corporation, ticker CMCSA. This is out of the communications sector. We picked up those 6 shares at $39.21. Starbucks, we continue to add 10 shares a week, and we're going to continue to do that probably as long as it stays in the mid 80s or lower. Still under 80, so I took advantage and added 10 more shares of Starbucks Corporation, ticker SBUX, out of the consumer discretionary sector. And I'll be honest, right now it looks like the consumer discretionary sector is starting to pull back. I'm seeing a lot more companies in my portfolio, as well as companies that are seeing big drops in the consumer discretionary sector, which leads me to believe that the consumer is starting to feel the pinch of higher than normal inflation for longer. But that's the idea of raising rates. So hopefully as people stop spending, it'll start to bring down that inflation back into the 2% range, which it's not significantly higher. It's in the 3% range, but they want to get it back to the 2% range. So with the way these companies like Starbucks, which consumer discretionary means those are things people can go without, right? You're not going to go without the necessities, your milk, your bread, your meats, that sort of thing. But for a cup of coffee or a cup of tea, you know, you might pull back on that. So I'm starting to see some weakness in some of these consumer discretionary stocks, but that is the opportunity for us as dividend growth investors to buy them cheaper. That's the idea. So 10 more shares of Starbucks at $77.35 per share, and 7 more shares of CVS Health Corporation, ticker CVS, out of the healthcare sector at $57.39. And this one continues to pull back. I think it was even down a little bit lower than this, maybe 55, 56 by the end of the week. Now this $1,410.50 and the additional shares that it added here added an additional $48.86 in passive income over the next calendar year. And we weren't done. We went back into the portfolio on the 24th here. We added another $352.91. And with those funds, we picked up one of our weekly buys. We're going to be buying SCHD every week, regardless of what the market is. So one more share of Schwab Strategic Dividend Growth ETF, ticker SCHD, at $78.18. We added, this was actually the last purchase we made. We had a little bit of funds left over. So we added one more share to our Vale position. This is a mining company out of the materials sector, and Schwab is an ETF. Vale, a mine out of the mining sector. We picked up that one share at $1, or one share at $12.69. And this is not one I'm looking to add to significantly, but I may nibble a little bit here while it's under $13 per share. And our other weekly ETF, VTI, this is Vanguard's Total Stock Market ETF. This is the entire United States stock market. We added one more share at $262.04. And to be honest with you, I almost went in and bought, and I should have went in and bought on Thursday. It was down to $259 per share. I could have got it a few dollars cheaper. This $352.91 added an additional $8.45 in passive income over the next calendar year. Total invested $1,763.41. Total passive income added $57.31. So you'll notice again, significantly less than what we didn't add. We actually added $63, and we added more than we added last week. And I think we were right around 100, maybe 99 or $100 added in additional passive income. But the difference between last week and this week, even though we invested a little bit more, or right around the same amount, I think it was $60 more, $63 more, somewhere in that. The difference was no companies paid out dividends. Last couple weeks, we've had nice big chunks, several different companies paying dividends. And whenever those companies pay out dividends, they go in and buy more shares, and that adds to that dividend snowball even more. So you can see that from week to week, whenever you add in the same amount and you get dividends, this passive income number really shoots up. And then whenever you don't, like this week, it's significantly lower. So easy to see how a portfolio over time, those dividends really start kicking in and adding to the portfolio as time goes by. And we're going to run through the portfolio update sector weights here. Communications makes up 9.86% of the portfolio. Consumer discretionary, that's the one right there. Starbucks, you've got Baba in my portfolio. You've also got Haverty Furniture in my portfolio. Those are type of companies that are discretionary. Some other ones out there would be like a Best Buy, right? Companies like that. I'm starting to see a lot of Burger King, fast food joints. A lot of companies like that are really starting to get hit pretty hard. And it's because the sales are starting to slow down, which tells me we may be entering into a recession, or consumers are just going to start pulling back and maybe not buying those discretionary items, which again, hint, 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 wink, wink, might be time to start looking at that sector if that's what happens. Consumer staples makes up 9.88% of the portfolio. Energy at 5.85%. Financial 6.12%. Healthcare makes up 13.78%. Biggest slice of the pie here. Industrials at 6.77%, technology 6.85%, materials 10.96%, utilities at 10.15%, REITs and real estate, another sector that's being hit right now, along with the healthcare sector. Those three sectors, like I said, consumer discretionary, healthcare, and utilities, REITs and real estate are really looking like there's a lot of attractive value there right now, in my opinion. And ETFs is still the smallest sliver at 2.84%. Eventually, I would say if we continue to add to VTI and SCHD, eventually this will catch up to the rest of the pie and make more of a position, more of a percentage. But right now, still the smallest, 2.84%. And over here to the right, you can see these sector weights broken down the same percentages as the pie over here, but then also the monetary amounts associated with each sector also. And here it is, my portfolio. Again, I show this every Sunday morning, typically at 7:30 a.m. And I do that because I want some of the newer investors out there to get a little bit encouragement, a little confidence, to be able to see a portfolio built out over time, see the ups and downs associated with the market, the ups and downs associated with the portfolio. You can see here the red and the green. It really shows it pretty easy. You're going to have some companies up, some companies down. That doesn't mean to panic. That doesn't mean to bail out of them. If you've done the research and they're good companies, and the fundamentals haven't changed with the company, this is the opportunity to buy. When you start seeing those big drops, I'm down 18% on CVS, so I've been adding to CVS. Comcast, I'm down 7% on Comcast. I'm building that position out still, so I don't mind it being down. That means I get a cheaper price on those shares, and if I was comfortable buying it at $41.76 per share, I should be more than comfortable buying it at $38.54 per share. Again, unless something has fundamentally changed with the company, right? They're no longer making revenue. Their earnings per share growth is negative. Their outlook has changed. They're losing subscribers. Something like that for the company would have to drastically change for me to be wanting to get out of this company. But when I see the red, for me, like I said, negative 7.71%, that's a buying opportunity. Right now, Ally is just the opposite. Whenever I see companies that run up by 50%, I am not looking to head to Ally right now. I'd like to. If it pulled back significantly, I would like to. More than likely, though, if it was to drop significantly, I don't know that it would even hit my price. So really, I'm waiting for this 15% of 52-week low to get high enough where I can add some more, where it doesn't bring my average cost per share down. But anyway, here you can see in this column all the tickers, all the companies within the portfolio, how many total shares I have, the current price as of the close of business on Friday, the market value, again, as of the close of business on Friday, my average cost per share, my purchase price, this is how much I have into each position, my total return, what I'm up or down. Again, the red means I'm down, black means I'm up. Percent return here, same thing, just color-coded in the percentages. What sector each company falls in. What we saw on the previous slide was each sector broken down by percentage. Quarterly dividend, monthly dividend, or semi-annual payer in these columns. What their current yield is, their yield on my yield on cost, and the portfolio weighting. Again, the previous slide, what we saw was the sector weightings. This is each individual position, and estimated annual income in this column here. Payout months here, dividend growth, and where it sits at 15% at 52-week low. I think I cover this every time we have an update, but some of you are going to be newer, so you might not know. 15% of its 52-week low just gives me a price that I want my cost per share to be under, or try to keep it under, or it gives me a limit of what I'm willing to raise up my cost per share as I build out a position. Like, for example, Ally. It's up significantly, so I'm not looking to really add to it much, right? But if I was looking to add to it, I wouldn't want this price, $25.70, to go over $25.92, because that's my limit of where it sits at 15% of its 52-week low. Now, as this goes up, that might give me an opportunity in the future to add some to it, even though it's up significantly above my cost basis. So total shares in the portfolio, 6,662.825. Current portfolios worth $254,390.04. Purchase price $243,961.03 is what I have into it. I am up $10,429.02. Down significantly from last week. I think this was at like 14,000, almost 15,000 last week. So we are down a little bit from last week. Up overall 4.27%, and that's just the way the market is. Up one week, down the next. It's the roller coaster of the market, folks. That happens, right? Current dividend yield, 4.343%. My yield on cost, 4.529. And that's why it's circled in red. This is what I'm really focused on. I'm not focused on whether I'm up or down. I'm not looking to sell any of the positions in my portfolio unless they no longer meet the criteria that I bought them at. Then I would look to sell them. This continues to grow, sitting at $11,049.37, under $1,000 before we get to that next milestone in my portfolio, $12,000 a year or $1,000 a month. That's really the next milestone for me. And I think we're exiting May, entering into June. I think by the end of July, we're going to be very close to being over $12,000 in estimated annual income per year, or that $1,000 a month. And I think if that is the case, if we hit July and by the end of July we're at 12,000, that should put me pretty close to, by the end of the year, hitting 14,000, if not just a little bit over 14,000 a year in estimated annual income. with the income that I add plus the income that the dividend payouts will buy new shares, and the income that those shares will add as well. Dividend growth is sitting at 5.84% year over year. And that is it. Let me know if you have any questions on the portfolio. I know some people have asked about this spreadsheet. I did not create this spreadsheet. I got this from Ryan. He's another dividend growth investor out there. I can link it in the comment section down below. He gives it away for free also. I think he has a little different one now that he does. Has some more charts and stuff. So if you want to go check out his channel also, you might be able to get his for free. But I'll put this down in the link. I didn't pay for this. He doesn't charge anything, so I don't think he would mind if I put it down in the comment section. So I'm going to do that. I have tweaked it a little bit. He didn't have the 15% of the 52-week low. I've got a couple extra tabs that I've added to it. So I'll link it down there if you guys want it. If not, don't worry about it. Again, it's free. And that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. Again, I do this portfolio update as well as a stock pick of the day series Monday through Thursdays. So make sure your notification bell is tuned in to get those notifications whenever those new videos dropped, and make sure you're subscribed to the channel as well. Drop a comment down below. Let me know what you're buying. If you're selling anything, I know a lot of people are worried that we're at the top of the market and maybe it's time to sell. And maybe you are. Maybe you're taking some profits, and that's perfectly fine. What are you selling? What are you looking to roll those funds into? I know some people are taking profits and they are just setting the cash aside for a potential drop. I think that's a little bit of timing the market, but I get if that's what you're doing. You can't lose money by taking profits, right? But let me know if you are selling anything, what that might be, and what you're buying. And as always, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for tuning in. I hope you are having a great Memorial weekend, and we will see you in the next one. I'm not a financial advisor. Go ahead and read through this the rest of the way. I'm a little tired, and I got to go make some burgers for the kids. So read through this if you're interested, but I'm not a financial advisor. You should be doing your own research.